gentlemen, and members of the press, the Monetary Policy Committee met on the 20th and 21st of November 2017 against the backdrop of a relatively optimistic global economic outlook. The committee reviewed key developments in the global and domestic economies during the first 10 months of 2017 and assessed the risks to price and financial stability in the short to medium term, as well as the outlook for the first half of 2018. 9 members of the MPC were present at this meeting. External developments. Global output is projected to improve to 3.6% in 2017 from 3.2% in 2016. The revised growth forecast reflects the uptick in global economic activity, strengthened by the recovery in oil and other commodity prices, and leading to improved aggregate demand. Growth in the advanced economies is expected to improve to 2.2% in 2017 from 1.7% in 2016. Similarly, emerging markets and developing economies are forecast to grow at 4.6% in 2017, up from 4.3% in 2016. The MPC, however, noted some risks to the outlook for global growth, to include continued tension in the Korean Peninsula, complexities arising from the Brexit negotiation, and financial market uncertainties due to monetary policy normalization in the United States. The committee noted the pace of increase in inflation in the advanced economies, with the exception of the United Kingdom, is expected to be considerably slow towards the end of 2017. In the emerging market economies, inflationary pressures have abated as key economies exit recession and their currencies stabilize. Inflation is projected at 1.7% and 4.2% in 2017 in the advanced and developing economies respectively. The committee observed that the outlook for global monetary policy remains largely accommodative in support of economic recovery and growth. Data from the National Bureau of Statistics indicate that real gross domestic product, GDP, grew by 1.4% in the third quarter of 2017, up from 0.72% revised, and contraction of 0.91% in the second and first quarters of 2017, respectively. The major drivers of real GDP growth were agriculture, 0.88%, and industry, 1.83%. Some subsectors contracted, including construction, 0.01%, trade, 0.29%, and services, 1.02%. Overall, non-oil real gross domestic product contracted by 0.76% during the third quarter of 2017. Given credence to the argument that more work is required to consolidate the recovery process by putting in place policies that will boost growth through the non-oil sector of the economy. The committee also noted the continuous positive outlook based on the Manufacturing Purchasing Managers Index PMI, which stood at 55.0 index points in October 2017, indicating expansion in the manufacturing sector for the 7th consecutive month. 11 of the 16 subsectors reported growth in the review period. Also, the composite PMI for non-manufacturing sectors stood at 55.3 index points in October 2017, indicating growth for the 6th consecutive month. The committee hopes that while the economic recovery appears to remain fragile, a tenacious implementation of the 2017 budget and quick passage of 2018 budget would boost aggregate demand and confidence in their economy. The committee noted that money supply contracted by 5.54% in October 2017 annualized, in contrast to the provisional growth benchmark of 10.29% for 2017. The development in M2 is largely due to the contraction of 37.5% in other assets net. Similarly, M1 contracted by 7.79%, annualized to minus 9.35%. Net domestic credit expanded by 1.18%, annualized to 1.42%, driven primarily by net credit to government, which also expanded by 7.6% against the program growth of 33.2%. Credit to the private sector, however, contracted by 0.24% in October 2017, compared with the provisional benchmark of 14.88%. The Monetary Policy Committee also noted the structural constraints in the transmission of credit to the real sector of the economy, as well as the rising unemployment level. The committee urged the management of the bank to continue to encourage deposit money banks to accelerate the rate of credit growth to the real sector of the economy. Inflationary pressures in the economy continue to moderate, with headline inflation year-on-year receding for the 9th consecutive month to 15.91% in October 2017 from 15.98% in September 2017. Food inflation fell marginally to 20.3% from 20.32% in September, while core inflation increased slightly to 12.14% from 12.12% during the same period. These developments were attributable to the contraction in money supply, favorable but dwindling base effects, and the relatively stable Naira exchange rate. In spite of the marginal decline in food inflation in October, the committee noted that the rate remained high, traceable to cross-border sales, distribution bottlenecks, rising prices of farm inputs, supply shortages, as well as ongoing harvest of some farm produce. Money market interest rates oscillated in tandem with the level of liquidity in the banking system, as the average interbank call rate, which opened at 12.0% on October 3rd, 2017, closed at 5.38% on November 16, 2017. The open buyback rate, OBB, opened at 10.41% and closed lower at 6.02% in the same period. However, the average interbank call and open buyback rates for the period stood at 10.94% and 10.15% respectively. The development in the net liquidity positions and flows reflected the effect of Federation account payments to states and local governments, remittances by the Nigerian Customs and the Federal Inland Revenue Services. OMO sales, foreign exchange interventions, and maturing CBN bills. The committee noted the continuing improvement in the level of external reserves and the equities segment of the capital market. External reserves grew to 34.9% at the close of business on November 16, 2017. Similarly, the all-share index rose by 3.38% from 35,504.62 on August 31, 2017 to 36,703.58 on November 17, 2017. Market capitalization improved by 4.35% to 12.77 trillion naira from 12.24 trillion naira during the same period. Relative to the end of December 2016, capital market indices rose by 36.57% and 38.1% respectively, indicating rising investor confidence due to improvements in the foreign exchange supply. Total foreign exchange inflows through the central bank declined by 6.61% in October 2017 compared with the previous month and attributable to the decline in crude oil and gas receipts as well as revenues from petroleum profit tax and royalty payments. Total outflows, however, increased by 18.7% during the same period as a result of interbank sales, direct payments, and JVC calls. The committee noted the gradual convergence between the rates at the Bureau de Change and the Nigerian autonomous foreign exchange market segments, as well as the stability of the exchange rate at the interbank segments of the foreign exchange market during the period under review. Similarly, the committee reviewed with satisfaction the growing patronage at the investors and exporters window of the foreign exchange market and attributed the development to increased confidence by foreign investors and the preference of the Nigerian investors and exporters window compared with all other windows. The MPC noted that the investors and exporters window had increased liquidity and boosted confidence in the market with over $18.7 billion in transactions since its introduction in April 2017. Forecasts of key macroeconomic variables indicate a positive outlook for the economy up to the first quarter of 2018. This is predicated on continued implementation of the 2017 budget into early 2018, anticipated improvement in government revenue from the implementation of the voluntary assets and income declaration scheme, as well as favorable crude oil prices. The development finance initiatives by the central bank in the real sector, particularly to the agricultural sector, are expected to continue to yield positive results in terms of output expansion and job creation. Focusing on the downside risks to the outlook, committee noted the low fiscal buffers and weak aggregate domestic demand. On the external front, widening global imbalances and rising geopolitical tensions were some of the crucial risks identified by the committee. The considerations of the committee. The committee noted with satisfaction the second consecutive quarterly growth in real GDP following 5 quarters of contraction. In addition, members welcomed the relative stability in the exchange rate, particularly the narrowing premium and the very slow deceleration in consumer price inflation, largely attributable to base effects. Overall, the economy has begun to show strong signs of recovery as public investments has picked up with increased housing construction at the federal and state levels, as well as shipping activities at the ports to support the rising purchasing managers index. The committee was, however, of the view that policymakers must not relent in their aggressive policies initiatives aimed at continuing the positive growth trajectory. The committee was also concerned about potential adverse external developments and the cautious approach to lending and the financial intermediation by domestic deposit money banks. Committee similarly evaluated other concerns in the domestic economy and opportunities for strengthening output recovery, noting that some highly critical sectors were yet to resume growth. Committee also noted the significant contribution of food prices to headline inflation and observed that the benefits of base effect on overall headline inflation has substantially dwindled. Members, however, expressed confidence that the tight stance of monetary policy and the stability in the exchange rate of the naira should continue to positively weigh in on price development and inflation. Committee reaffirmed its commitment to maintaining price stability, which is crucial to sustainable economic growth and development. The committee welcomed the review of the Economic Recovery and Growth Plan in an effort to realize the objectives of the plan. In the same vein, committee urges a quick passage of the 2018 appropriation bill by the National Assembly so as to keep fiscal policy on track and deliver the urgently needed reliefs in terms of employment and growth of the economy. On financial stability, committee noted the concentration of non-performing loans in a few sectors, but observed that the overall condition and outlook for the banking system was stable as deposit money banks' balance sheets remained strong. This assertion is strengthened by the developments in the national accounts and the expectations that the affected sectors are returning to growth. Nonetheless, committee urged for strengthening of supervisory oversight and early warning systems in order to promptly identify vulnerabilities and proactively manage the emerging risks in the banking system. The committee further observed that government was increasing debt, both domestically and externally, thus crowding out the private sector. The committee's decision. In arriving at its decision, the committee appraised potential policy options in terms of the balance of risks. The committee also took note of the gains made so far as a result of its earlier decisions, including the stability in the foreign exchange market and the moderate reduction in inflation, and thus extensively deliberated the options regarding whether to hold, to tighten, or to ease the policy stance. While tightening would strengthen the impact of monetary policy on inflation with complementary effects of capital flows and exchange rate stability, it nevertheless could also potentially dampen the positive outlook for growth and financial stability, as this would constitute a risk to the productive sectors of the economy. On the other hand, whereas loosening would strengthen the outlook for growth by stimulating domestic aggregate demand through reduced cost of borrowing, it could nevertheless aggravate upward trend in consumer prices and generate exchange rate pressures. Committee also feels that loosening would worsen the current account balance of the country through increased importation. On the argument to hold, the committee believes that key variables have continued to evolve in line with the current stance of macroeconomic policy and should be allowed to fully manifest. Members noted that the developments in output and inflation in particular required effective close monitoring in order to gain clarity on the medium-term optimal path of monetary policy. In consideration of the foregoing, the committee decided by a vote of 8-1 to retain monetary policy rate at 14% alongside all other policy parameters. One member voted to reduce the MPR by 100 basis points. Consequently, MPC voted to 1. Retain MPR at 14%, 2. Retain CRR at 22.5%, 3. Retain the liquidity ratio at 30%, and 4. Retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR. We thank you for listening.
Good afternoon, Mr. Governor. My name is Godwin Emefiele. I'm business editor for AIT. You talked about structural constraints to credits. Now, I'd like to expatiate on that, and the CBN trying to work with banks on these structural constraints. Talking about credit, I know that banks, about 13 banks are exposed to loans because of a T-salad loan, about $1.2 billion of a T-salad loan. I know UBA, Fidelity is exposed to about $55 million. That's about 17.3 billion naira GTB and access. Now, we are also aware that there are talks around that Barclays, because of its exposure, are thinking of pulling out as financial advisors. What is the CBN stance on all this? And finally, sorry, one last question. You are reported to have said that you are optimistic that the inflation rate will get to single digits as at next year. What informs this your optimism? Thank you.
Nigeria. The MPC has repeatedly called on CBN to advise or encourage banks to lend more to the productive sector of the economy. Now, it's obviously isn't yielding the desired result. What other options are available to the CBN to ensure that more credit finds its way to especially young businesses?
Good afternoon, Mr. Godwin.
Hold on. Yes.
The first question is, in your speech, you did talk about the MPI growing, the Purchasing Managers Index, manufacturing, but from the NBS report, we're seeing that the non-oil sector is still suffering from earlier cyclical shocks, weakness in the structural economy, which can also be very deceptive. So which do we believe now? Because there seems to be a mask. We don't know what to believe. MPI, on one hand, growing, the non-oil sector is seemingly still in recession. So how do you connect these dots? Then the second one, just to buttress what my colleague earlier asked, I want to ask you how satisfied you are with the conduct of the sale process of Nine Mobile as a regulator in that industry, where banks right now are battling with a lot of non-performing loans. Thank you.
Good afternoon, everybody. My name is Chijoke Ekechukwu, the Director General of Abuja Chamber of Commerce. It is indeed my pleasure to find out. Sometimes we get worried when we see certain countries that we consider bigger than economically, countries in Africa having lower inflation rates, far lower than what we had. And we wonder what they do to achieve that feat. We understand the efforts made by the CBN, and we also know, the second question is, many times we know that there are sectoral allocations given to credit facilities for commercial banks. Many times banks do not fulfill the obligations of meeting those quotas given to them in giving credit facilities. We don't see them punished in order for the plans for various sectors to be achieved by the CBN and for the economy. Thank you.
Good afternoon, everyone. I'm Shikio Laikinaye. Sir, you mentioned, I work with TV. You noted the increase in domestic and foreign debt. I just want to know MPC's stance on this.
Any more questions?
Good afternoon, sir. My name is Mark Tibo from Leadership. Sir, we heard that you were abroad. We know that you were abroad recently on the issue of roadside show. Sorry, road show on
Road show on Eurobond.
I think he wants to know, he's aware that you were part of the team that went on the road show for the Eurobond. And he wants to know how successful that trip was.
Yes, I'm sorry about that. I want to actually know how successful was your road show.
Okay. No, the first one was my own question.
My name is Rally Atadere from Classic FM. Please, I want to know the amounts in the ECA. Then the Senate recently called for an abolishment of the ECA with regards to owing to its illegality and abuse. What's your reaction towards this? Thank you.
Okay, so it's left for the governor to please answer this question. There are so many. Thank you.
Budget, borrowing requirement, and $3 billion for refinancing of domestic debts into external. The roadshow actually took place on Thursday and Friday, and I'm sure you're all aware that yesterday the pricing was done, and the information that I got was that the bond was oversubscribed to the tune of about $11 billion. However, we could only access $3 billion in two tranches, 15-year and the 30-year tranches. I think one was at 6.5, the other at about 7.38 or so percent. So from there, you will note that the investor confidence in the Nigerian economy continues to be strong, based on most of the macroeconomic indices, and also supported by the decisions of both the monetary and fiscal policies. There is confidence by the investor community about what the government is doing, and it delights us that the level of confidence has improved, and hence you've seen that the activities of the monetary and fiscal authorities has resulted in the country exiting recession. My only advice is that as policymakers, we cannot rest on our oars. We need to remain focused, and I keep saying that for a country that grows its population by an average of 3%, nothing short of going back to the historical levels of average of 6% would be considered good. Yes, we know it's a long journey from 1.4 to an average of 6%. With tenacity, with lots of work being done, with aggression and focus being shown by the policymakers here, I'm talking of monetary, fiscal, and trade policymakers, I'm very optimistic that we will get there, and in short time. NTA is asking that yes, that we would have observed as increasing domestic and foreign debt, and that what is the MPC stance? There is nothing wrong in borrowing, and I think I'm even quoting the finance minister saying this, there is nothing wrong in borrowing. But I think what is very important is that how do we deploy the funds being borrowed? But I'm happy that the specific reasons for these borrowings are targeted at infrastructural development. I am sure that you all know that most of the borrowings right now is targeted to infrastructure, road development, construction, rail, airports, and various other infrastructural development projects that will spur economic activity in the country and ultimately continue to accelerate the growth trajectory of the country. Why do other countries have lower inflation rates? Let me say that between 2013, early 2013 and 2014, or up to around 2015, the central bank set an inflation target of 6 to 9%, and this was substantially adhered to. But we must realize that those were periods from 2012, and we keep saying for 5 straight years, from 2009 to about 2014, crude prices averaged $110 per barrel. Reserve accretion at a point in 2008 stood at $62 billion. Exchange rate stability was taken for granted during those periods. But unfortunately, beginning from the third quarter of 2014, we got hit by 3 external shocks. The drop in commodity prices, and for us, crude price, the geopolitical tensions along various trading routes along the world, as well as the United States normalization policies. These had tremendous adverse consequences on our economy, and hence you could see that inflation moved from 9% in January 2016 to 18.7% in January 2017. And that is the reason Monetary Policy Committee thinks that it is too high, and we're working very hard, taking very seriously our mandate for price and monetary stability to rein in on inflation and see to the fact that inflation is brought down to the traditional levels where we have a target of between 6 to 9%. We're working hard at it, and I remain optimistic that with the focus and tenacity of Monetary Policy Committee, that this will be achieved. What is CBN doing to ensure more credits to the SMEs? The response I have here is that, well, the Central Bank of Nigeria, other than supporting and encouraging deposit money banks to continue to lend money to this sector, the Central Bank itself has a 220 billion micro, small and medium enterprise fund, which I keep saying is even less than 50% accessed. So there is a lot of opportunities for this to be accessed, and at single digit or no more than 9%. So that for us is what we are doing. How satisfied is CBN with the sale of the process of 9 Mobile? You all recall either at the last MPC or the penultimate one, the issue of 9 Mobile came around. Because the regulators, here I mean the NCC and CBN, see 9 Mobile as a systemically important telecommunication network in Nigeria, these two institutions decided to intervene to see to it that 19 million subscribers do not just start beginning to run helter-skelter without finding a place for cover. And we thought that the best way to handle this was to stabilize the company, see to it that banks and other important creditors do not go into a journey of dismembering the company, and I use the word, and this may lead to the loss of confidence even in the telecommunications and the banking sector. So NCC and CBN intervened to see to the stability of the company and also see to it that there is a transfer of ownership from Etisala to new investors. That process had continued. Well, just like in normal, I use the word in normal processes, there would sometimes be cases where things are not done the way you expect them. But what the NCC and CBN has come in to do is to correct some of the anomalies that we find in the process, the sale process at this time. And I'm optimistic that the sale process is still on track. There is a determination that that sale must take place before December 31, 2017. We remain focused on it. Somebody hinted me that, that the newspaper carried that Barclays had withdrawn. I would say that Barclays was hired with a letter. So Barclays, if they decide to withdraw, will do so by way of a letter. But as I speak with you, there is no letter. I don't want to say that that was false, but I'm only trying to let you know the process. The process is they were appointed by way of a letter, and they will also do so if they want to withdraw by way of a letter. I repeat, I have not said a business they told a lie, but the process is still on course. The banks and the regulators and other important stakeholders, here I'm talking about Huawei, IHS, Nokia, we are holding constant meetings to see to if an amicable and harmonious transfer of ownership from the existing owners or the gone owners to new owners by December 31, 2017. So no cause for alarm, no cause for worry, no cause for subscribers to think there's a problem with 9 Mobile. I repeat, everything is on course. Is CBN optimistic that inflation will hit single digits next year? We are working, the Monetary Policy Committee is working very hard on this, and with the support of other important policymakers, we are optimistic that we will get there. When we talked about exiting the recession during the second quarter, many people did not believe us. Let's hope that as we say that we're going to hit single digit by next year, this forecast or this prophecy will also come to pass. Thank you very much. Well, I think my colleague is just telling me that we have retiring five of our MPC members. This was their last meeting, and we seize this opportunity publicly to thank them, congratulate them for an excellent work. It hasn't been easy, and we wish them well in their future endeavors, and also thank the President for appointing people to take over their job. And we are very optimistic that by the next Monetary Policy Committee holding in January, you will see substantially new faces. Thank you very much.
Thank you. Well done.
Yeah.
Thank you. We can relax and listen to the post-community analysis while the governors prepare to the offices. Thank you very much.
Thank you.